All right. We're starting a little bit early today. I'm going to be in a meeting at our usual time. But why don't we go ahead and get started? So welcome, everyone. Welcome to our weekly Facebook Live chat here. Today, we're going to continue our discussion around the new tax law that was passed in late 2017, and yet another opportunity that's presented itself for people to take advantage of some of the things that changed under this tax law. You know, we've done a deep dive onto the specific ramifications of tax law on this page before, and we've also talked a little bit about some of the unintended consequences of things like how student loan repayment plans are going to be affected by the law. But there's another thing that's popped up related specifically to retirement accounts. And I want to credit a person named Ed Slott, who's an industry thought leader on IRAs and Roth IRAs in my industry, for coming out with an article a few weeks ago that jogged my thinking on this. And I want to give him credit for raising some of these issues. But I think it's a really interesting approach that you can take to take advantage of some of the changes under the tax law. Really, what we're going to talk today is about a really specific short-term opportunity for you to take advantage of between now and April 15th, 2018. But if you're listening to this later, this really can apply for any year under the current tax law. So I'll mention that off the top. At a high level, I kind of outline the steps of how to take advantage of the tax law change, and then dive into them and explain them a little bit more, right? To just give you the strategy up front. At a high level, this is going to involve making a 2017 contribution to your IRA account, to your traditional IRA account. Later on, down the line, several months from now, you're going to convert that IRA account to a Roth IRA account later in 2018 or even in early 2019, and then ultimately pay the lower tax rates on that contribution, and for the rest of whatever you contribute. So let's dive into what exactly that means. And we need to start off with talking about the difference between the traditional IRA that we're going to start with and a Roth IRA. So traditional IRAs, if you have a 401k, it works very similar to a 401k. The money you put in is directly deducted from your taxable income this year. So, the maximum you can contribute if you're under 50 years old is $5,500 for 2017. If you make that max contribution of $5,500, you can directly deduct that full contribution from your taxable income for 2017. And in turn, that money is going to grow, but because you didn't pay taxes on it now, you're going to end up needing to pay taxes on the money you put into a traditional IRA when you take it out of your account when you retire. A Roth IRA is the exact opposite. So you're going to contribute to a Roth IRA now. You're going to contribute with after-tax money, right? So this isn't going to affect your tax return today in any way. You contribute with after-tax money. It grows, but because you pay taxes on it up front, when you take out the money in retirement, there's no tax on that. It allows you to grow your money tax-free until you reach retirement. The contribution limit for that is $5,500 as well. There is one caveat to the Roth IRA, and that is there are income limits for who is eligible to contribute to a Roth IRA. So if you're married, you have the ability to contribute to a Roth IRA up until your combined income reaches $186,000, and then your ability to contribute starts to phase out up until if you make over $196,000, you can't contribute at all. And this is for tax year 2017. If you're single, the income limit starts to fade out at $118,000, and by the time your income reaches $133,000 per year, you're ineligible to make a yearly contribution to a Roth IRA. One more point about each of these accounts is that you have up until tax day to make contributions for the previous tax year. So for tax year 2017, you can make that $5,500 contribution to either a traditional or Roth IRA up until April 15th of 2018. So that's what we're talking about, right? That's the difference between the traditional IRA, which we're going to start with, and then moving over to a Roth IRA, which is the after-tax money. Here's the thing, right? There's with the change in tax code, the way that you're going to be taxed on a traditional IRA versus if you put money in your money into a Roth IRA is changing the margins from 2017 to 2018. And that allows the opportunity to almost an arbitrage opportunity to take advantage of the shift in tax rates if you do this correctly. So step one, right, to get back to the steps of what we're actually doing here. Step one is you have, like I said, until April 15th of 2018 to make a 2017 contribution to your traditional IRA. In turn, if you contribute that maximum of $5,500, you can deduct $5,500 from your taxable income under the old tax rate. Right? Remember, even though the tax law was passed, at the end of 2017, the new tax code doesn't take effect and it didn't take effect until January 1st of this year, which means that the first tax tax filing that is going to apply to the new rates is in early 2019. So you like I said, for 2017, you make a traditional IRA contribution this year. Step two is to wait a while. You can't do these right off the bat, right one after the other. This is a very legitimate process, but the IRS frowns upon doing this too rapidly. It needs to be two separate steps that you take. So typically, I recommend people wait about a year to do this next step. But if you have an older IRA that you have money in, you've contributed to in years past, you really can do this at any time going forward. So after a while, right, after you make that traditional IRA contribution for 2017 between now and April 15th, and deduct that from your income, so you're not paying taxes on it under the old tax law, you take that money and you convert it to a Roth IRA. Like I said, wait for a little bit before you do that. The reason why you do this are a few, right? First and foremost, if you're young, that the ability to defer the taxes that you're paying for a Roth IRA, in my opinion, is one of the best deals that are out there. You contribute with after-tax money now, and that money grows tax-free for 40, 60, 80 years, right? However long you keep the money in that account. And particularly because tax rates are at very, very historical levels right now, in terms of how low they are, I do think it's a decent bet that taxes are going to be higher across the board when we retire. So therefore, if we pay the taxes on the money now by contributing to the Roth IRA, and we don't have to under the theoretical high tax rates later on, that ends up being a good deal for us. Again, we don't ultimately know what we're going to be paying in taxes when we retire, but based on how low taxes are right now compared to where they have been, I do think it's a good bet that taxes are going to be higher, even potentially significantly higher 30, 40, 50 years from now. So anyway, getting back to the strategy. We take the traditional IRA money, convert it to a Roth IRA account. Now, what we've done is we've taken an account that we have not paid taxes on yet, convert it into a after-tax account, which means that we do need to pay money, right, in taxes on the total balance that we convert. This isn't a way to get out of paying taxes at all, right? But you deduct your income under the old tax law, and then pay the balance, or pay taxes on the balance that you're converting from a traditional to a Roth IRA later on, right, under the new tax law, which in theory, your rates are going to be lower. You should double check that before you do this. But the idea here, right, is just to say it one more time, is that you can contribute to a traditional IRA for 2017, take the income tax deduction, convert that into a Roth IRA later in 2018 or even in early 2019. You end up paying income taxes on the amount that you're converting, but it's under a lower tax rate, which is the arbitrage opportunity that's available for you right now. I mentioned earlier that there are income limits to contribute to a Roth IRA. There are no income limits to convert your traditional IRA to a Roth IRA. So if you make too much to just make flat out contributions to a Roth IRA, this is a way to get around that, if you will. Like I said, you do need to do this in two separate steps because in theory you're not supposed to be able to do this, but it is permissible to make these two separate steps if they're far enough apart. And given the change in tax law, you have an opportunity now to pay less in taxes than you would have before if you were to do this. Now, it's important to note, if you have money in an old 401k from an old job, you can actually convert that account as well. You would need to move it to a traditional IRA and then once again convert it into the Roth IRA and pay taxes on the balance. The downside to that is if it's a bigger account, if you have a lot of money in an old 401k, then you're going to end up paying more in taxes immediately. But again, I think particularly if you're younger and you're going to be keeping that money in an account for a long time, taking the tax hit now if you can afford to pay it while keeping your money growing tax free for the rest of your life is a good trade-off if you can pull it off. And likewise, if you have other IRAs, really, so if you're doing this IRA conversion into a Roth IRA, we really should talk about it one-on-one if you're only going to do this for some of your IRA money. The tax the tax implications of this can get pretty complicated if you're not doing it with kind of everything or just 1 year's contributions if you don't have an IRA already. So that's something we should talk about to make sure it's the right thing for you to do before and to make sure we know what the tax consequences are going to be. But the strategy works ultimately with any money you have in a traditional IRA or an old 401k if you choose to move it to a traditional IRA as an intermediate step. If the only other thing I'll say about that is that you can't do this with your current job's 401k, right? Until you leave that job, you need to keep your money in your current job's 401k, right? So that wouldn't apply, but you can do it with 401ks from old jobs. I guess to wrap up, this process of contributing to a traditional IRA, converting it to a Roth IRA, paying the taxes on the balance now, and then letting it grow tax-free is a good strategy. But 3 warnings I'll give you before we do this. First and foremost, you need to carefully calculate how much you're going to owe in taxes if you do convert your traditional IRA to a Roth, right? You don't want to be surprised, particularly, like I said, if you have other IRAs that are out there. Number 2, check your tax rate, right? So there are a handful of people whose tax rates have gone up under the tax law. It's not a lot of people. Most people are going to have an income tax reduction, but make sure that this actually is a good deal for you, right? Make sure that you're by contributing this year and deducting under the higher rate and then converting under the lower rate, make sure it actually is a lower rate before you do this, right? And yeah, that's all I'll say about that for now. And then finally, right, be aware that this cannot be undone, right? Once you convert a traditional IRA to a Roth IRA, under the new tax law, you can't go backwards. You can't go from the Roth IRA to a traditional IRA for whatever reason you change your mind. It's important to note, you used to be able to do that. So if you start Googling Roth IRA conversions, you will see some older articles that are out there that say you can undo it after a period of time, but that's no longer the case. The new tax law actually changed that as well. So before you could undo this if you weren't happy with the decision, but now you really can't. Right? Once you make this conversion, it's set in stone, done for good. So that's the process, right? Roth IRAs are a fairly complex topic. They do involve a lot of math. Unfortunately, I tried to summarize it at a high level as succinctly as I could. But again, right, the Roth IRA strategy, the Roth IRA conversion strategy in general, you contribute to an IRA, you take the income tax deduction, you wait a little while, you convert the IRA to a Roth IRA, pay taxes on the balance that you're converting, and let the money grow tax-free from there. Like I said, particularly good for younger people, or in general for people who think that their tax bracket in retirement is going to be higher than their tax bracket now. And that strategy works all the time, but particularly with the change in tax law, you still have a few months, right, up until April 15th, 2018, to take the income tax deduction under the higher tax rate to save you ideally more money on taxes now than you would if you convert it down the road. So you have until April 15th to make that 2017 contribution, wait a while, and then convert it to a Roth IRA, pay taxes on the balance, and let your money grow tax-free from there. And the only other date I'll throw out there is, it's important to keep 2 different dates separate. April 15th is the deadline to contribute to either a traditional IRA or a Roth IRA for the previous tax year. For the conversion deadline is December 31st. So in other words, if I convert a traditional IRA to a Roth IRA on December 30th, 2018, that would show up on my 2018 tax return. I'd have to pay the balance at that point in time. If I did it on January 1st, 2019, it would be on my 2019 tax return, and that I would pay in April 2020. I could make a 2018 contribution to a traditional IRA on January 1st, 2019, that would show up on my 2018 tax return. But the conversion, if I did it on January 1st, 2019, it would show up in 2020. So anyway, I know tax law is complicated as always. I hope this is helpful and gives you a little bit of an idea for some, if this is the right situation for you, it could be something to consider going forward. For more ways to kind of take advantage of some of the changes in tax law that have happened over the past few months, go ahead and click the link in the video description, and I have a pretty lengthy list of different ways to take advantage of the change in tax code. Anyway, thanks so much for watching, and I hope you have a good day.